All right, everybody. Thanks for taking time out of your conference to join the presentation this morning. I think most people here have no Peachtree. I think not everybody does. So this presentation is going to go real briefly over who we are. And then we're going to talk about private credit. I'm just going to kind of zoom right into that, what that is, and kind of why that's relevant right now. So I want to introduce also in the back, Josh Rubinger. Josh is our head of national accounts. Josh, how long have you been in real estate private equity space?
You're going to age me now. When I joined, they said industry veteran joins Peachtree. So that's a nice way to say old guy. I think like 20 years.
20 years. 20 years. Oh, sure. 20 years. Right. I got about 15 and change. So we've been doing this for some time. And it's nice to kind of get some recognition. I don't know if you guys saw Blackstone and Vanguard always coming in late as usual. Just gonna sorry. I'm sorry. Blackstone and Vanguard just announced that they're making some kind of arrangements to work together. To me, what that says is two things. One, it's a nod to the fact that the modern portfolio needs alternative investments. But again, Vanguard is sort of notorious for being passive managers and just track an index and low cost and all that. So to see them say to Blackstone, hey, you guys need to help us provide something that's different than a bond or a stock to our clients is, I think, a nod to the alternative space. That's one thing. The second thing, though, is that now almost anybody can access Blackstone. So that's not terrible. It's a good thing. But what are we doing as financial advisors to distinguish ourselves from what the client can kind of get on their own, right? And that's what we do here at Peachtree. We provide investments or institutional quality investments that you can get to your clients that they can't get otherwise. They can't get them through Vanguard. They can't get them through Schwab. They can't get them through the platform. They have to go through you. And you're doing something very relevant to them. So again, who's Peachtree? Denise, I know you know us a little bit, but some people that don't. We're a real estate private equity firm that was established in 2007. See, we have some pictures of our guys. Here we are in 2007 as a family office. So the title of this presentation, I think, has something to do with institutional high income. I think what says. I should probably know that. But institutional side, and this is really important because when you're talking about alternative investing or, real estate private equity, there's an illiquidity component here that you have to consider. So we start by talking about that our firm started as a family office. So there's really these three individuals, Greg Friedman, Desai, and Atul Patel. They put their own money into the original deals along with their family's money. What started as a family office where they would buy, build, and lend on commercial real estate assets. In particular, back then in 2007, they were doing this in a specific sector, which was select service hotels, premium branded, Marriott, Courtyard Marriott, Residence Inn, things of that nature. The traveling hotels that I stay in, not something like this, not a nice resort and not budget, right in the middle, sort of middle market. And they got started. Daniel Siegel joined about 6 years ago as the fourth principal. And he came from a real large real estate private equity firm where he was really in charge of lending credit. But the point I'm trying to make here is that the four of them together have invested in our offering of over $100 million of their own money in our offerings. So when you're talking about Peachtrees, you're talking about, institutional money, and you, Mr. Client or Mrs. Client, your money are coming together to invest together. On top of that, there's family office money for our credit fund. I'm going to talk about in just a second. It was seeded by a very large institution, by Clipwater. Again, so we started, hey, Vanguard, Blackstone, what are they doing? What am I doing for my clients? I'm giving you an institutional quality fund. Literal institutions are invested in this. Clipwater seeded this. So what that means to me is two things. One, if Clipwater's investing in this, Peachtree got scrutinized like you wouldn't believe, right? These guys, we literally had to restructure some of our entities because of their influence. So that's one. The second thing is if my client's going to take some liquidity risk to invest in this, and Peachtree says, hey, we're going to go this way, and then 3 years later, we decide to kind of turn right, we kind of change what we were going to do, we're going to get a call from Cliffwater, right? They're going to say, hold on a second, what are you guys doing, right? We're also going to get a call from Greg Freeman's mother because she invested in this stuff too, right? So you get the point that we have institutional money that invests in these funds, and it helps mitigate the risk that your clients are taking. Here is what we do. It's we buy, we build, we lend. We're a real estate private equity firm. We have about 300 people in our corporate office in Atlanta. That's where the name Peachtree comes from. If anyone's been to Atlanta, every street is Peachtree Avenue, Peachtree Road, Peachtree. It's Peachtree everything. Amazon, I have no idea how they deliver anything because everything's Peachtree. So we kind of give ourselves away by calling ourselves Peachtree. But if you rewound 5 years ago and people said, oh yeah, I know Peachtree, they're the hotel guys. Or maybe 7, 8 years ago. They're the hotel guys. They're really good at that. Matter of fact, the operating business has about 3,000 people. In our hotels in the country, we have about 3,000 people that operate our hotels, which is pretty awesome. A pretty big division of what we do. However, if you look at our verticals, I said we buy, we build, we lend, right? We do those 3 things. Our biggest position is credit. This is actually already outdated. Transacted on $7.5 billion. In reality, we're at like $8 billion. The opportunity to be the lender in commercial real estate right now is tremendous. So we're quickly becoming a very, very big player in the credit space. We started that again back when we started, brought on Dan Siegel. And so when we buy or build something, so if we're buying something through our DST platform, it's going to be a hotel. It's going to be a hotel, our core competency. When we develop something, it's going to be a hotel. When we lend in our credit space, we're going to be lending against hotels. We're going to be lending against multifamily, self-storage, industrial, across commercial real estate in general. So those are our 3 verticals, and we are growing pretty strongly right now. We're pretty excited about it. So this brings us to the market opportunity for private credit. If you remember, something happened in 2007, 2008, right? I can't remember. It was something small. Yeah, the great financial crisis, GFC, took place, right? And in response to that, interest rates came down to 0. We all know this story. And then from then until about 2022, we were in a low interest rate environment. It was almost artificial. Young people don't even realize how not normal it is to get a mortgage. Even I get my brother got a mortgage under 3%. It's crazy. Good for him, really happy point. But all of a sudden in 2022, interest rates came up. We know this story. So what did that do? What that did, when you move rates like that and that quickly, it's like a tectonic shift, right? It's not a small thing, it's a big thing. So everything started to reprice. All real estate started to reprice. Value started coming down almost immediately. Value started coming down. What also was taking place was commercial real estate owners that had debt that was originated before 2022 were starting to sweat because they were saying, wait a minute, I got to refinance this. And the rates were here. And when I'm going to go refi, rates are here, right? The math isn't mathing, so to speak, right? So those are 2 things that took place. Real estate values changed, and now I got to go refinance. The third thing that happened, which is really where the market opportunity exists to be the lender today, is regional banks who used to service all this debt, and we're talking about trillions of dollars of debt coming here. They call it the wall of maturities. The regional banks used to service this debt. They exited the space. Well, I wouldn't say exited. Their hands are tied because they already have too much commercial real estate on their balance sheets, and all that real estate just priced down. So they're sitting on all this real estate, and then another owner comes in and says, help me refi. And they said, sorry, we can't. And they used to service about 40% of that debt. So what do? If you're a real estate owner, I do something. I got to go somewhere to service my debt. And that's where we come in, right? We're not a regional bank. We're a real estate private equity firm. We buy, we build, we lend, right? And these firms come to us and they say, help us out. We got to do this. And we say, maybe we will, maybe we won't, right? It's a really good position for us to be in because we can be super scrupulous about what we're going to work with and then come up with our own terms. And by the way, if something should, especially in the hospitality sector, if God forbid they should go under, we'll just take the property and we'll manage it because, again, we buy, we build, we lend, right? So thanks for listening to my little story here. But the
Insurance companies sell that to you, or say again, insurance companies, is that also?
we see their bids come in, but no, we typically we take bank notes from regional banks, and then we'll just go directly. Then I'll show you the slide, but we'll go directly to the owner themselves. Other PE firms actually too. So this is just slides. Follow what I just talked about. We're not really talking about office because that's an anomaly. Right now, I think most firms are going to put that on a shelf because of COVID. But, self-storage down 21, multi-family down 20. Hospitality has actually been fairly resistant because of inflation, because they can reset prices daily, so they can match inflation. But so these have already corrected, and that's, again, March 2022. I just told you that rates came up. That's why that happened. But this is the bottom line. So why would your client consider investing in commercial real estate credit? Well, if they were to invest in 2019, the credit position would give them about a 14 to 16% IRR. Okay, this is not the fund level. It's a good return. And they would have about 25% equity in front of it. So what that means to me is before this investment is impacted, you'd have to see 25% drop in value, right? Fast forward to today, or this is 2024, so this is already updated, but now you can get 18 to 20 because of what I said just a minute ago. You have all this debt coming due. The regional banks aren't theirs, have demand imbalance. They come to us. We're going to charge more to do it, right? But we also have 30% equity in front of us. So it's not 25. It's actually right now our portfolio's got like 35% equity in front of us. So that's why we call it defensive. You'd have to see these properties drop 30 to 35% before your investment is impacted. And by the way, so you're making a better yield, less risk, generally speaking. That's like the slide that shows the opportunity that exists today versus before rates went up in 22. You were asking, Todd, about where we get our deals from. Here's where we get our deals from. Whether REITs, co-lenders, owner-operators, brokers, PE firms, institutions, so it might be some insurance companies in there. Third-party databases. But this is what I was talking about, being scrupulous. I don't know, can you see this? It's a little... I don't have like rises on. I'm at a point in my life where I need glasses. It's like, what's going on here? Somebody stop the train. So we're sourcing about 75 billion, right? There's trillions of dollars coming. There's huge opportunity. We look at 75 billion, go through diligence. We close about $1 billion. So about 1% of the deals we look at, we actually close on. So it's a great opportunity for us. It's all to work for us. But that's how this whole machine works. We'll look at that amount and then with $1 billion out of that.
In the previous slide, let's say with a 30% cushion.
Yeah.
That doesn't, even if the value drops, doesn't necessarily equal default either, right?
Oh, like I said, we're a PE firm that we could take the property over hypothetically speaking. We've done that in the past.
But that's only if they don't pay the no.
Yeah, well, but we're just talking about when you're investing up and down the capital stack, you could be in the equity position and you're not going to get as good as returns being in the debt position. So why on earth would you do that, right?
And then this 30%, this is after the drop from 2000.
That's correct.
Right. It's like,
right. This is already after the prices have come down. So again, that's why we're calling this defensive, right? And how much time do I have, Josh?
You have 10 minutes or so.
10 minutes. So we're going to jump right into the fund. What we're doing, this fund is a private credit fund. Are we in a recession? Are we going into a recession? Does anyone know?
It just depends. And we change the definition of recession again.
Good question. Okay. So we don't know, right? Nobody knows. Some clients feel like everything's going fine. Some clients feel like maybe not. I think all of us can say we're not sure, right? So what this does for a portfolio, generally speaking, is you're going to give your client a fairly relatively decent income stream. This fund that we already raised $100 million in the fund, and it was seeded Cliff Water, so we have an institution in the fund as well. We're going to pay about an 8 to 10% income stream annually. It pays quarterly. And like I said, the average loan to value on the portfolio as it stands today is about 65%, right? So again, the downside protection there. So you have clients who are sitting in cash, some may be, some may not be. It's not a bad place to put some cash. If you have clients that are, maybe just concerned about what they're seeing out there, it might not be a bad idea, depending on the positions you got to, review with them. If they're more concerned, this again should be a nice way to mitigate some risk and generate a decent return. I've said this to some of you in this room. If you ask Goldman Sachs, maybe they know what you're talking about, maybe they don't. Ask ChatGPT, what does Goldman Sachs think the S&P is going to do over the next 10 years?
3% a year.
What do you say?
3% a year.
Yeah, is it 3?
Yeah, rents away. We buy room.
Who knows? He did.
So,
Who knows, right? J.K. Morgan said something like 6, but maybe there's some others that could change tomorrow. But the point is the returns, thanks to interest rates coming up, are not going to be maybe as powerful as they have been when rates are low, right? So this 8 to 10% consistent income stream for a client over the long term can be a very powerful return for them. We're not selling sizzle and steak here. This is more like a vegetable. It's kind of broccoli. But you give it to your client, and they're going to be grateful to get that 8 to 10, right? So we talked about the strategy. We talked about why there's this huge, opportunity. This is not our first rodeo. I'm not going to dive into this too deeply. If people want to really see how the watch works or how to, I just told you the time. I want to see how the watch works. We'll get into it. But effectively, because we have a really good relationships with regional banks, ironically, we can get lending to do this at a price that's less than what we're able to lend to get out. So there's an arbitrage play there that helps us generate a really good yield. We still have the position on the property where we take it over in the case of defaults, but this is an A-note, B-note structure. If people want to go over this in depth, I will go over it with you, no problem, but we don't have enough time for this presentation to go over. Here's some of our past credit funds. Like I said, this is not, what you'll see is a lot of people are talking about private credit because of this great opportunity. This isn't our first time doing this, right? We're not tourists or, rolling into this saying, hey, let's be private credit because it makes sense. We've been doing it for a while. The returns here are tremendous. I sometimes don't like showing them because, this is what happened in the past. We got to roll up our sleeves and do this again. So I don't know if you can see, again, it's a little bit blurry, I guess, but some of the IRRs, we got a 10% on this one, 8.5 or 8.85% on this one, 11.3 on this one. That's, so the returns are pretty good. And again, not our first rodeo. So we've transacted on about $7.5 billion, I think $8 billion at this point. And frankly, we'll probably have another fund after this. This is credit fund 4. We'll have another one after this. These are just some case studies. They're nice pictures. These are some properties in the portfolio. I like, my favorite part of all of this is the LTVs on these. Again, 57.9, 52.24, 58.3. And right now, I think our deal tape, we have like 24, 25, something like that right now. So we can share that too. If you guys are detail oriented and gals would like to, look at what's in the portfolio, we can do that. So yeah, in conclusion, you're getting an institutional quality investment. You're giving that to your client. They're getting a very good income stream. Call it, between 5 to 7 to longest could be 9 years. They could be the way liquidity works is the loans mature naturally, organically. So it's not like we go and list this on exchange. You don't sell this off. These loans mature. They're 3 to 5 year loans, but we have the right to reinvest with 1 year extensions. And like I said, not many times for free. Institutional investors, we're happy to do it for your clients if it makes sense for them in their portfolio. Anyone have any questions?
What's your experience been on real estate owned though? Let's say you have a default. What have you done it historically?
So we've only had what is under 2% default. So it hasn't happened a lot, but we've taken it over and, liquidated it accordingly. We had to wait for the market. Once your equity position, now you gotta wait to sell it. And that's been in hospitality. You haven't done that with multifamily or the other sectors, but we've taken over properties at discounts. You have other funds that are more loan to own strategies. There's kind of a little bit of risk there. That's not the strategy here, but we're equipped to do that if we need to. If that makes sense. This is more very basic, bland. We're just hopping in and taking advantage of that situation. We're giving a nice fixed income alternative to investors. The answer always is, it depends, right? Every client has different needs. They all have different time horizons, different risk profiles. There's still liquidity here. If your client can't hold this long term, they shouldn't be in it. But what I like about it, apart from having the institutions in it, is that the loans just mature organically. There's no surprise. Hey, we listed this company and it was here, and then all of a sudden it's dropped because there was no buy side pressure on it. So cash alternative, bond alternative. In some cases, people really need the income. They can liquidate some of their equity positions, but I'm not sure right now is a good time to do that.
So, but really, they should be prepared to stay there for 9 years.
Yeah, last dollar back.
I got you.
Right, last dollar back. So it's going to start liquidating probably year 5.
So maybe year 5, if you
Yes.
just 100,000, you
Yeah.
might get 10.
Yeah, the old portfolio, you're going to start liquidating at that time. And then, so depending on the term of the loan, it's going to start coming back.
I would think most clients should try to lock in. To a risky is if you notice. Now subtracting the Dame James one market, he's paying 5.38, now they're paying 4.02. Even though Fed funds rates haven't come down, I think bank rates are supposed to come down. People realize if they have money in CDs, those are starting to come down.
Yeah.
So the whole trend, we're now going to see world mortgages today.
Yep.
The trend is rates are coming down a little.
Yeah, that's right. Well, I don't think anyone thinks you're going to come down to where they were.
No.
But yeah.
I mean, you've already have a point. It's a lot. Now you had 4%.
Yeah.
Really, that most CD the cuts get repeating.
And you guys are qualified plan too.
Yeah, as a matter of fact, that's a really good idea if you can, because benefit from tax standpoint. So yeah.
Since you don't want to like get the hotel, the
Yes.
income.
Yep. Well, thank you
Hotel.
very much for your time. Appreciate it. We're gonna be at our booth. If you have any questions, we're here.
But not